Welcome to Talk Tickers. As a professional earnings call summarization podcast, our job is usually to dig into the weeds of corporate balance sheets. But for this deep dive, we are stepping back to look at the massive underlying financial topic that is literally driving every single earnings call in the industrial and mining sectors right now. It is Sunday, February 22nd, 2026. And I want to start today by asking you, just look at the scoreboard, because if you haven't checked your terminal or your feed in a week or two, you might genuinely think there's a glitch in the data. The U.S. national debt has officially crossed $36 trillion.
Yeah, which is, it's a staggering number.
Right. It's staggering, but it's almost just background noise at this point, right? We're so used to that number just going up. The real story, the thing we're doing a deep dive into today, is what is happening in the world of things you can actually touch. We're talking about gold flirting with $5,600 an ounce before settling right near that psychological 5,000 mark. And then you look at industrial metals, the actual stuff we build the world with, and copper is trading near $14,500 a ton.
It's a scoreboard that would have looked like absolute science fiction or maybe a hyperinflationary nightmare just 5 years ago.
Exactly. And it forces us to ask the big question today. We are witnessing a massive, undeniable reallocation of capital right now. Is this just a standard post-recession bounce? Is this just a little inflation flare-up like we saw in the early 20s? Or are we in the early innings of something much rarer, much more violent, and potentially much more profitable for those who actually position themselves correctly? Basically, are we right now inside a commodity supercycle?
That's the trillion-dollar question. And frankly, the term supercycle gets thrown around a lot by promoters. It's marketing fluff half the time. But to answer your question, we really have to strip away the noise. This isn't about day trading gold miners or, trying to catch a bounce in oil because of a storm in the Gulf. This is about a fundamental regime shift. We are seeing the collision of two massive tectonic plates that have been drifting toward each other for basically a decade.
And what are those plates specifically?
On one side, you have what we call fiscal dominance. That's a situation where debt servicing costs are actually exceeding defense budgets. And on the other side, you have a CapEx depression, which is years, arguably a full decade, of chronic underinvestment in the physical supply of raw materials.
Okay, hold on. Fiscal dominance and CapEx depression. Those sound like terms you'd hear at a very boring economics conference.
They do, yeah.
But I have a feeling they are the exact reason my grocery bill and my portfolio look the way they do right now. Let's break those down before we go any further into the mechanics. What exactly is fiscal dominance? Because I think our listeners hear debt numbers all the time, but the mechanics of it matter here.
It's actually quite terrifyingly simple. It's when the government's need to fund its own debt completely overrides every other objective of the central bank.
Yeah.
Imagine a household that has racked up so much credit card debt that the minimum payments are now higher than what they spend on food and rent combined.
Wow. Okay.
But they can't stop borrowing or they default immediately. In the U.S. context right now, we are at a point where the interest payments on federal debt are competing with, and in some metrics, exceeding the entire national defense budget.
So the government essentially has to keep the money printer on just to pay the interest on the money they already printed.
Precisely. And the market smells that. The bond market knows it. That's the fiscal dominance side. Then you have the collision with the CapEx depression. This is the industrial side of the equation. For the last 10 to 12 years, roughly since about 2014 or 2015, the world basically just stopped looking for new copper, new gold, new oil. We literally stopped digging holes.
So we have a government that can't stop spending money and an industrial base that hasn't started digging for the things we actually need to buy.
That is the perfect summary.
Mm-hmm.
And that collision creates what we're calling the hard asset renaissance. It is a massive pivot from fiat-denominated paper assets, things that can be printed by a central bank at the push of a button, into tangible stores of value, things you can kick, things you can weigh on a scale.
Okay, let's unpack this, because supercycle is a buzzword, as you said earlier. But we are here to define exactly what that beast is for you, the listener. We're going to look at the history, the 4 major cycles of the last century, to see if this current market matches the historical pattern. We're going to break down the supply and demand mismatch driving these crazy 2026 prices. And crucially, we're going to look at the winners and the losers. Because in a market like this, the miners and the manufacturers are on completely opposite sides of the battlefield.
They absolutely are. One man's price gouge is another man's margin expansion.
Exactly.
Wow.
So let's start at the very beginning. Define the beast. What is the actual difference between a regular business cycle, market goes up, market goes down, recession recovery, and a true super cycle?
It really comes down to two things: duration and structure. A standard business cycle, or what economists sometimes call an inventory cycle, typically lasts 3 to 5 years. It's driven by the short-term ebb and flow of economic activity. Retailers stock up for the holidays, they sell out, they restock, prices wiggle up and down based on that inventory.
All right, it's just the normal breathing of the economy.
Exactly. A supercycle is different. A supercycle is a sustained period, often lasting anywhere from 10 to 35 years, of broad-based, above-trend price movements. And the key here, the absolute defining characteristic, is that it's driven by a structural change in demand that supply simply cannot match quickly.
It's the cannot match quickly part that really interests me. Why can't it? If copper is $14,000 a ton right now, which is an insane price historically, why aren't people just grabbing shovels and digging more holes? Capitalism 101 says high prices equal more supply.
In a perfect textbook world, yes. But in the real world of geology and heavy engineering, no. This is the time to build lag. This is a core mechanic of the supercycle. Demand can change overnight. A government passes a massive stimulus bill. A war breaks out. A new technology like AI takes over and demands massive new data centers. Demand spikes instantly. But supply is geological. You cannot 3D print a copper mine. You cannot code a new lithium deposit.
Walk us through that timeline. Let's say I go out into the desert and I find copper today. When do I actually get paid?
Well, if you are lucky enough to find a viable deposit today, which is statistically very unlikely, because we've already found most of the easy stuff, you are looking at roughly 15 years.
15 years?
15 years. Year 1 to 3 is just exploration and proving the resource to see if it's even worth it. Years 4 through 10 are permitting, environmental impact studies, negotiating with local governments, securing water rights, and securing the billions in financing. Then, maybe by year 11 or 12, you actually break ground. You strip the overburden. You build the mill. You are incredibly lucky if you were shipping concentrate by year 15.
So that entire 15-year gap where demand is screaming and supply is stuck in court or under construction, that gap creates the supercycle.
Exactly. It creates a window where price becomes the only mechanism to ration demand. The price literally has to go high enough to kill off the buyers because no new sellers are coming to the party for a decade.
So the supercycle is essentially the market screaming for supply that just doesn't exist yet.
Correct. And these cycles have a very specific anatomy to them. Think of it in 3 phases. Phase 1 is the upswing. This is where unexpected, persistent demand meets rigid supply. Prices go parabolic. We are arguably living in the late stages of that upswing right now in 2026. Phase 2 is the investment phase. Capital finally floods into the sector. The miners get rich, they overspend, they build too much capacity, they get a bit arrogant.
The champagne phase of the cycle.
And then comes the hangover. Phase 3 is the downswing or the bust. Supply finally catches up and comes online, usually right as demand is starting to normalize. Prices crash below the long-term trend. Think about the 2010s. That was a classic bust phase.
So to be perfectly clear for the listener about where we are right now, February 2026, are we in the middle? The beginning, the end.
We arguably exited a cyclical bear market between 2022 and 2024, and we have entered a new cyclical bull market. But, and this is the key distinction, that the cyclical bull is taking place within a larger structural supercycle that likely began around 2020. We're in the acceleration phase right now, where the supply constraints are finally really biting.
To prove that this isn't just random market noise, we need to look back. You mentioned there have been 4 of these massive waves in the last 120 years. Give us the history lesson. I think it's really easy for us to have recency bias and think, oh, prices are up right now, it must be totally unique. But this has happened before.
It happens like clockwork, roughly every 30 or 40 years. And it always aligns with a massive shift in human civilization. Let's go back to cycle 1, which was the 1890s through the 1910s. What drove that? It wasn't just generic economic growth. It was the second industrial revolution. It was the rapid, aggressive industrialization of the United States.
This was the era of the robber barons, right? Rockefeller, Carnegie, Vanderbilt.
Exactly. We were physically building the modern world from scratch. We were laying massive railway networks across the entire North American continent. We were building the very first steel-framed skyscrapers. Urbanization was exploding. You had millions of people moving from farms to cities. That required steel, coal, copper for early electrification. It was an insatiable hunger for raw materials to build the actual infrastructure of the 20th century.
And once that infrastructure was largely built out, demand plateaued.
Eventually, yes. But then came cycle 2. which was the 1930s into the 1940s. Now, this is a grim one. This wasn't driven by prosperity or urbanization. It was driven by rearmament. The massive global buildup leading into World War II. War is incredibly commodity intensive. You need metal for tanks, rubber for tires, fuel for planes, copper for bullet casings. The entire global manufacturing base essentially pivoted to consuming raw materials for destruction.
So that pushed prices up significantly until the war ended, and then we had the post-war boom.
Right, which leads seamlessly into cycle 3, the 1960s and 70s. This was the reindustrialization of Europe and Japan. Remember, Germany and Japan were flattened. Their infrastructure was gone. They spent 2 solid decades rebuilding their cities, their electrical grids, their factories. That massive construction boom drove global demand for 20 years. It eventually ended with the oil shocks in the 1970s, which is a whole other story of supply constraints. But it killed the growth.
And the one most of our listeners probably remember vividly, cycle 4, the China boom.
The absolute big one. This ran from the late 1990s, peaking around 2011. This was the industrialization of emerging markets, completely led by China. It is genuinely hard to overstate how much stuff China bought during this window. At its peak, China was consuming 50% of the world's concrete, 50% of the world's copper, 50% of the steel. They built entire ghost cities, thousands of miles of high-speed rail, massive hydroelectric dams. It was the single largest migration of humans from rural to urban living in human history.
And then it just stopped. 2011 hit, the peak was in, and prices crashed. And that brings us to the lost decade of 2011 to 2020. I want to spend some real time here because I feel like this is the trauma that explains the current market psychology we're seeing on these earnings calls today. What happened there, and how did it set the stage for 2026?
This is arguably the most important part of the story for investors today. You really have to understand the psychology of a modern mining CEO. After the 2011 peak, commodity prices absolutely collapsed. Gold fell, copper fell, oil crashed famously in 2014. Mining companies had spent billions of dollars building massive new mines during the boom, assuming prices would just stay high forever. Suddenly, prices crashed, and they were losing money hand over fist.
Their shareholders must have been absolutely furious.
Furious is a massive understatement. They wanted blood. Wall Street completely turned on the sector. They fired all the visionary, geologically minded CEOs who wanted to explore and build, and they replaced them with accountants, with cost cutters. The mandate from Wall Street was incredibly clear. Do not spend a single dollar on a new mine. Give us our money back.
So the entire industry just went into a shell.
We call it the CapEx depression. For 10 years, the mining industry practiced extreme capital discipline. They completely stopped looking for new metals. They slashed their exploration budgets by 60, sometimes 70%. They just milked their existing assets dry to pay massive dividends and fund stock buybacks. They essentially cannibalized their own future just to survive the present and keep the activist investors happy.
It's like a farmer who decides to stop planting seeds because grain prices are low this year. He saves a ton of money on seeds today, but next year he has absolutely no harvest.
Exactly. And we spent a full decade not planting seeds. Now, in 2026, the demand is roaring back, but the harvest isn't there. That chronic underinvestment sowed the seeds for the severe shortages we are seeing today. We are paying the price right now for the 2015 bear market.
So let's talk about the guests at this current party. We've established the historical pattern. Let's look at the specific drivers of this 2026 supercycle. You mentioned earlier that supply is rigid, but for prices to be this high copper at $14,000, demand must be doing something truly special. What is pushing prices to these insane levels right now?
There are 3 main drivers right now. The first one is entirely on the demand side, the green industrial revolution. And I want to be really clear here, I'm not making a political statement about climate change. I am making a math statement. This cycle is different because it isn't just about more people entering the middle class. It's about a massive change in energy intensity.
Meaning the things we buy every day require more raw stuff to make.
Much more. Let's look at the electric vehicle. A standard internal combustion engine car, your average gas guzzler, uses about 20 kilograms of copper. An electric vehicle uses roughly 80 to 100 kilograms of copper. That is a factor of 4 or 5. Then you add the lithium, the nickel, the cobalt, the graphite. An EV is essentially there's a massive chemical battery with wheels attached. It is a highly mineral-intensive machine.
But are people actually still buying EVs at that rate? Because you hear reports that sales are slowing down or plateauing in certain markets.
The growth rates definitely fluctuate month to month, sure.
Yeah.
But if you were looking at the global fleet, the transition is undeniable, especially when you look at Asia and Europe. But honestly, even if you completely ignore the passenger cars, look at the grid itself. The build-out of clean energy is effectively a global reindustrialization project. We're trying to completely replace a fossil fuel energy system that took 100 years to build, and we're trying to do it in about 20 years. Wind turbines, massive solar farms. These are huge consumers of zinc, rare earths, and silver. A solar panel is basically just a high-tech silver sandwich.
And it's not just the power generation either, right? It's the transmission of that power.
Correct. We are trying to electrify everything. That means rebuilding the entire electrical grid to handle decentralized intermittent power. A modern grid is essentially just millions of miles of copper and aluminum wire. And we haven't even touched on the digital side yet, AI data centers.
The AI boom, this is fascinating because everyone talks about the chips, they talk about the NVIDIAs of the world, but they rarely talk about the physical plumbing required to run those chips.
Exactly. An AI data center consumes vast, almost incomprehensible amounts of power. That requires massive liquid cooling systems and heavy-duty electrical wiring just to handle the load. That is all copper. You cannot have artificial intelligence without the physical reality of copper wire. So you have the green energy revolution and the AI revolution happening simultaneously, and they're both aggressively fighting for the exact same limited supply of metal.
Okay, so demand is absolutely exploding because our technology is suddenly incredibly hungry for metal. That brings us to driver number 2, the supply cliff. If prices are high and we know demand is there, why aren't the miners just ramping up production? You mentioned the time to build lag, but is there something else fundamentally going on?
They're definitely trying to ramp up, but they are running headfirst into 3 brick walls. The first wall is grade decline. We have simply mined all the easy stuff, the high-grade deposits that were sitting right near the surface, the ones where you could just dig a relatively shallow pit and find 3% copper ore. They are gone. We mined them in the 1900s. Now we are mining much lower grade ore, maybe 0.5 or 0.6%. That is much deeper underground and significantly harder to process.
Which means you have to physically move and crush a lot more rock just to get the exact same amount of final metal.
Exactly. It costs more energy, more water, more labor, and more money to get the same output. We are running on a treadmill just to stand still. The second wall is ESG and permitting. Environmental, social, and governance regulations have made it incredibly difficult and painfully slow to open a new mine. In the US or Canada, it can easily take 15 to 20 years just to get a permit. You have endless environmental impact studies, community consultations, indigenous rights negotiations, lawsuits from NGOs.
Which, to be fair, prevents us from completely destroying the local environment, but it definitely strangles the global supply.
It is a massive trade-off.
Yeah.
We desperately want green energy, but we absolutely do not want the mines required to build the green energy in our own backyards. It's a huge paradox. And the third wall, geopolitics. We call it resource nationalism.
This is the get off my lawn policy for countries with resources.
Basically, yes. Countries that actually have these resources, places in South America like Chile and Peru, or in Africa like the DRC, they see the prices going up. They look at the terminal and see copper at $14,000. And they say, wait a minute, that is our copper. We want a much bigger cut. So they are demanding higher taxes, steeper royalties, or in some extreme cases, threatening outright nationalization of the assets. They are restricting exports. Look at what Indonesia did with nickel. They flat out banned the export of raw nickel ore to force foreign companies to build the processing smelters right there in Indonesia. It makes the entire global supply chain incredibly fragile and unpredictable.
So we have exploding structural demand and severely constrained fragile supply. That is Econ 101 for higher prices. But there is a third driver you mentioned at the top of the show, and this one feels less about the physical metal itself and more about the money. Driver number 3, fiscal dominance.
This is the critical monetary angle. You absolutely cannot separate physical commodities from the global macroeconomy. We are currently in what I call the debasement trade.
Unpack that for us. Why does the U.S. national debt make the price of physical gold go up?
Because eventually the math simply breaks. Global debt is at absolute record highs. We're talking over $340 trillion globally. We mentioned the U.S. debt earlier. The interest payments on that debt are astronomical. Central banks around the world are effectively forced to keep liquidity flowing just to service that debt. They can't afford to let the financial system seize up, and they cannot afford real interest rates to remain too high for too long, or the governments literally go bankrupt.
So they essentially keep the money spigot open. They actively choose inflation over a sovereign default.
Which heavily devalues the fiat currency. When you print more money to pay off existing debt, or simply to keep the bond market functioning and liquid, the actual purchasing power of that money goes down. Investors see this happening in real time. They see this fiscal dominance where the government's desperate need for money overrides everything else. So they start buying commodities not just to build things, but as a safe store of value. They are fleeing the dollar, fleeing the euro, and buying gold, silver, even physical copper. They fear their currency is melting like an ice cube, so they buy hard assets.
That perfectly explains why gold is sitting at $5,000 right now. It's not just people buying jewelry in India, it's systemic fear.
It's the ultimate portfolio stabilizer. It is the only financial asset on Earth that is not simultaneously someone else's liability.
Let's dive deeper into these specific assets. We've talked about the big macro picture. Let's talk about the market reality that you're seeing. You mentioned Dr. Copper earlier, the absolute king of the cycle. Where does copper sit right now in 2026?
Copper is the ultimate bellwether. If you want to know how the global economy is actually doing, forget looking at the S&P 500. Look at the copper chart. It is trading near $5.85 to $6.50 a pound. That translates to $13,000 to $14,000 a ton.
That is a massive move. I remember when $4 copper seemed really expensive.
It is a historic move. And the underlying mechanic is simple. Structural supply deficits. We are projecting a physical deficit of approximately 330,000 tons in 2026 alone. Now, that might not sound like a huge number in a massive global market, but in a very tight market, the marginal ton sets the global price. But what's truly fascinating right now is the institutional rotation.
What does that mean exactly? The big boys are moving their money around.
The really big money. We're talking pension funds, university endowments, sovereign wealth funds. For years, if they wanted a hard asset allocation, they just bought gold. But gold feels a bit expensive to some of them now at $5,000. So they are rotating their capital into strategic copper. They realize copper is no longer just a boring industrial metal for home plumbing. It is a highly strategic asset for the future digital economy. You cannot have AI without copper. You cannot have the energy transition without copper. It has become an absolute must-own asset for national security and future tech infrastructure.
So it's officially graduated from the hardware store to the bank vault?
In a very real way, yes. It's being rapidly financialized. There are physical ETFs now that just hoard copper cathodes in warehouses, taking it off the active market, which of course squeezes the available supply even tighter for the actual manufacturers.
Speaking of bank vaults, let's talk about the traditional monetary metals. Gold and silver. Gold is at 5,000. Is that the ceiling or just a rest stop?
Gold is just doing its job. It's the portfolio stabilizer we talked about. It preserves purchasing power over long periods. If you look at gold priced in terms of other major currencies, the Japanese yen, the euro, the British pound, it has been hitting all-time highs everywhere, not just in dollars, but silver. Silver is the high beta play of this cycle.
High beta meaning it moves faster and much harder than gold.
Much, much harder. Silver has risen over 100% since the start of 2025. It is completely outpacing gold's percentage gains.
Why the massive outperformance? Silver usually lags behind gold, doesn't it?
Usually, yes, it takes a while to catch up, but silver has this unique dual personality. It is a monetary metal. People buy it when they don't trust the dollar or the banks, exactly like gold, but it's also a vital industrial metal. It is absolutely critical for solar panels, the photovoltaics, and ion electronics. Every single solar panel manufactured needs a significant amount of silver paste. And we are seeing a massive global surge in solar installation right now. At the exact same time, it has recently been designated a critical mineral by the US government. We are seeing export restrictions from major producing nations. So you have this severe industrial squeeze happening simultaneously with a monetary panic. That combination is absolute rocket fuel for the silver price.
But with rocket fuel comes intense volatility, right? If I go out and buy silver today, am I going to sleep well at night?
Absolutely not. And that's a serious warning to the listener. Silver is incredibly volatile. Traders call it the devil's metal for a reason. Even in a raging bull market, you should fully expect 5 to 10% drawdowns in a single week. It corrects violently to shake out the weak hands. It is definitely not for the faint of heart. But the upside potential, given the physical shortage, is explosive.
Let's pivot to the corporate level, because this ties right into the earnings calls we usually summarize. We've talked about the physical metals, but what about the actual companies? Who are the winners and losers in this specific environment? Because high commodity prices are great for some, but they are an absolute disaster for others.
It is entirely a tale of two sectors. The massive winners right now are the pure play miners with existing producing operations. Think of companies like Newmont in gold or Freeport-McMoRan in copper.
Why them specifically? Why not a junior exploration company who just found a promising rock in Nevada?
Because the big established guys have operational leverage. Their baseline costs the cost to dig the hole, pay the staff, run the massive dump trucks, keep the lights on. Those costs are relatively fixed, or at least they rise much slower than the spot price of the metal. But the price of what they sell, the actual gold, the copper, is skyrocketing. So if the price of copper goes from $4 to $6, that's a 50% increase in top-line revenue. But because their costs are fixed, it might be a 200% increase in their actual profit margin.
They are just printing free cash flow right now.
They are generating absolute record free cash flow. And because of the capital discipline we talked about earlier, the lingering PTSD from the 2015 bear market, they aren't blowing it all on risky new mega projects yet. They're still terrified of overspending and angering Wall Street. So what do they do with all that cash? They pay massive special dividends. They buy back their own stock aggressively. They are basically becoming high-yield value machines.
And losers, because someone is paying for this party.
The heavy manufacturers, the people who actually have to buy this raw stuff to make their finished products. Look closely at the auto industry. Companies like Ford, GM, or Tesla. Their raw input costs are soaring. If the price of copper, lithium, and nickel goes up 20% in a quarter, that eats directly into their profit margins on every single car they roll off the line. They are faced with a terrible choice. They either have to raise prices for consumers, which immediately kills demand, or they eat the cost internally and watch their stock price suffer.
What about the airlines? They must be feeling this too.
Hurting very badly. Jet fuel costs are up, obviously, but they also have new green surcharges. And the sheer cost of buying new fuel-efficient planes is rising because those planes use more exotic, lightweight metal alloys. The basic cost of doing business for anyone who consumes physical commodities is rising significantly faster than they can safely raise prices for their end consumers. It's a brutal margin squeeze across the board.
I want to touch on the geographical aspect again before we run out of time. We talked about China driving the last cycle. Everyone says China's growth is severely slowing down right now. They are shifting to a consumption economy. They are building way fewer of those famous ghost cities. Doesn't that just kill the cycle dead? If your absolute biggest buyer stops buying, doesn't the price crash?
That is the standard bearish argument, and honestly, it's the one most mainstream macroeconomists get completely wrong. They are constantly looking in the rearview mirror. Yes, China's infrastructure growth is absolutely slowing, but they completely miss the India factor.
The baton.
Yes, exactly. We are seeing a massive demographic divergence. China is aging rapidly. Their population is actually shrinking now. But India is just entering its massive, intensive industrialization phase. They have 1.4 billion people, a very young, average demographic age, and they desperately need modern infrastructure. They need paved roads, reliable electrical grids, modern housing, new airports. India is absorbing huge amounts of global liquidity and demanding massive quantities of gold, silver, and copper. They are the new engine of global commodity demand. It's not that the engine stopped, it just physically moved across the Himalayas.
So India is essentially the new China in terms of commodity consumption for this super cycle.
And it's not just India, to be fair. It's Indonesia, Vietnam, Nigeria. The entire global south is industrializing right now. They all want what the West already has: reliable electricity, personal cars, modern air-conditioned buildings, and providing that standard of living requires an unimaginable amount of metal.
We have to be balanced here, though. We've painted a very, very bullish picture for commodities. What actually kills this cycle? What are the concrete risks to this thesis? Because as we know, trees don't grow to the sky.
There are three main risks that genuinely keep me up at night regarding this thesis. First is straightforward demand destruction. Prices get so high that the ultimate cure for high prices is high prices. People simply stop buying electric vehicles because they're $40,000 too expensive. Home builders stop building houses because the copper wiring and materials cost too much. The entire global economy just grinds to a halt under the weight of the inflation.
The consumer just taps out completely.
Exactly. A severe global recession. If we have a massive recession, demand for absolutely everything falls, and commodity prices will crash temporarily, regardless of the supply constraints. Second is technological substitution. You should never, ever bet against human ingenuity. If lithium gets too incredibly expensive, maybe we invent a battery that uses abundant sodium instead.
Like salt batteries.
Yes, sodium-ion batteries. Or we shift heavily to iron phosphate. We are already seeing lithium iron phosphate innovations taking massive market share. If we innovate our way out of using these specific scarce metals, the demand cliff disappears overnight. If copper gets too expensive, maybe engineering firms figure out how to safely use aluminum for a lot more wiring applications.
And the third major risk.
Policy reversal. Central banks wake up one day and decide they have finally had enough of the inflation. They decide to stop fiscal dominance in its tracks. They jack up interest rates to the moon, 10%, 12%, Volcker style, to intentionally crush the economy and stop the bleeding. That kills demand instantly, causes a severe depression, and commodities crash. But given the massive debt loads we discussed earlier, I honestly don't think they can actually do that without bankrupting the sovereign government in the process.
So it's a very precarious tightrope walk for the central banks.
Yeah.
But right now, in early 2026, the momentum clearly seems to be with the commodity bulls.
The structural deficit is the absolute key. Until new supply physically comes online, and remember, that takes 15 years, the price has to stay elevated to incentivize that future production.
So if I'm an investor listening to this deep dive, how do I actually construct a portfolio around this? What is the functional role of commodities here for a retail investor?
You have to really understand correlation. In a low inflation world like we enjoyed for the entire last decade, stocks and bonds work great together. They balance each other out perfectly. But in a high inflation supercycle regime, stocks and bonds often fall together. They become highly correlated.
The traditional 60-40 portfolio just breaks down.
Exactly. It fails to protect you. Commodities act as the ultimate diversifier. They are often the only major asset class that consistently performs well in high inflation regimes, specifically when inflation is running stubbornly over 4%. They zig when the rest of your traditional paper portfolio zags. You need that structural insurance.
We've covered a huge amount of ground today. The history of the cycles, the physical mechanics, the specific metals, and the corporate winners and losers. If our listener is sitting there right now looking at this massive commodity rally, maybe seeing gold sitting at 5,000 and thinking, did I miss it? Should I chase this rally? What is the single most important question they need to ask themselves to cut through all the daily market noise?
The one question you have to ask is this. Is the price spike I'm seeing on my screen right now driven by a temporary supply shock, like a labor strike at a major mine or bad weather in a shipping channel? Or is it driven by a massive structural deficit that capital expenditure simply hasn't fixed yet?
And why does that specific distinction matter so much?
Because temporary shocks fade in a few weeks, and they absolutely kill momentum traders who buy the top. But structural deficits last for years, sometimes decades, and they build dynasty wealth for those who are patient. You want to be investing in the long-term structural deficit, not gambling on the temporary headline shock.
That is the ultimate takeaway right there. We are looking for the deep structural problems that money hasn't solved yet.
Exactly.
Let's recap quickly before we sign off. Based on everything we've synthesized today, we are likely in a new structural bull market, a true supercycle driven heavily by the green energy transition and a full decade of severe underinvestment. Supply is incredibly rigid, it just can't react fast enough. Meanwhile, demand is accelerating rapidly due to global reindustrialization and the massive AI boom.
And it is all wrapped in a hard asset renaissance, fueled by geopolitical tension and the very real fear of sovereign debt. The entire monetary landscape is shifting beneath our feet, and hard assets are the direct beneficiaries.
The era of easy money is truly being tested. Volatility is going to be incredibly high going forward. We certainly aren't saying commodity stocks go up in a straight line forever. But as we discussed, don't mistake a normal market pullback for the end of the supercycle. In a supercycle, those corrections are often the best opportunities, provided that the underlying structural deficit remains intact.
Keep your eye on the time to build lag. Until those new mines are actually built and shipping ore, the upward pressure remains.
And finally, a provocative thought to leave you with as you review your portfolios. We talked a lot about gold and copper today, but what happens if fresh water becomes the next tradable commodity supercycle? As we reindustrialize the globe and run these massive AI data centers, water intensity is quickly becoming the next massive hurdle, something to mull over as you watch the tickers this week. Thanks for listening to Talk Tickers. We'll see you in the markets.